Hello and welcome to the White Feather Investment Finance module. I'm happy to be here. My name is Julianne Peterson and I'm a commercial loan officer for Old Capital Lending. And before we get started with the finance, I'd like to let you know a little bit about Old Capital. So come join me. A little bit about us. We are a premier provider of commercial capital in primarily multifamily properties. About 93% of our business is done in multifamily. However, the other asset classes like storage, mobile home park, office, retail, industrial are some areas that we also provide debt for, but our real focus is on multifamily. We really pride ourselves on execution certainty. So what does that mean? Well, a lot of times we will give you a debt quote that will give you information on how much LTV that we will provide, how much debt service that we require. And many times we will find that we will give you the bad news up front because we want you to be aware of the challenges that we know will be happening on this property. We want to give you all of that bad information up front so that you're not retrading, so that you don't need to go to your investors to get more capital. Execution certainty. So we really like to find solutions. We like to lend advice and ultimately provide personalized customer service to let us provide the next loan. Execution certainty. A little bit about me. I've been in real estate for 30 years. My first home was in Los Angeles at the age of 22. I now own and manage properties here in San Diego. As well, I'm a passive investor on properties, multifamily properties in Texas, in Kentucky, and I also own a shopping center in North Carolina. So as a commercial loan officer at Old Capital, I work with all types of real estate, but I really do like to specialize in multifamily properties. I'm also another advisor on an education program. I do weekly Zoom calls. I have a meetup here in San Diego. And you know, most of my clients become good friends because, as you know, we do business with people that we know, like, and trust. Lastly, I am a wife of 24 years to a great guy named Robert, and I'm a mom of 4 great kids. Old Capital was started in 1989 by Paul Peebles in Dallas, Texas. We now have a team of 8, and we've closed 5,700 loans. That's a lot of loans. And that makes up, in the last 2 years, $1 billion. $1 billion in 2018. $1 billion in 2019. That's a lot of loans. That's execution certainty. Anyone heard of the Old Capital podcast? We're now at 65,000 weekly listeners. We also do a national conference yearly. This is held in Dallas, Texas. This will be our 4th year this year. We've had some rock star keynote speakers. We started out 3 years ago with Rob O'Neill, a real favorite in your line of work. And he came to talk to us about teamwork. And these are our offices, 6 across the United States. Well, actually 5 are in Texas and 1 is here in San Diego. And I'm here to tell you that there is multifamily outside of Texas. Let's talk about financing that we provide at Old Capital. We kind of look at this as ice cream options. So let's talk about ice cream at the Old Capital Ice Cream Shop. Before we go there though, before we go shopping for your favorite ice cream, let's talk about finance. Let's talk about your business plan, your strategy. These are the things that I'm going to want to know about your deal before we even look at finance. Are you going to be holding this for short term? For long term? Are you going to do a rehab? Is it going to be a legacy asset? Where do you live? Why do you like this property? Are you thinking about rehabbing it? How much are you looking to rehab? I'm wondering if you've ever syndicated. Oh, you've never syndicated. Well, do you have a deal sponsor? And in fact, how much money are you going to be bringing to the deal? Are you going to be using other people's money? These are all questions I have for you. And when we talk about agency debt, we're going to want to understand what your net worth and liquidity looks like. We'll talk about that more later. So here at the Old Capitol Ice Cream Shop, we have 5 flavors for you to choose from: vanilla, chocolate, coffee, cookies and cream, and Rocky Road. What option will you choose when you're shopping at the Old Capitol Ice Cream Shop? Well, let's call these flavors options. And our first option or flavor is Fannie Mae, or potentially Freddie Mac. This is a non-recourse loan option. And this option works very well on stabilized assets. And by that I mean an asset that has a occupancy of 90%, physical occupancy, or 85 economic occupancy. Well, what does that mean? Physical means they're living there. Economic means they're not paying you. When we size these Fannie Mae or Freddie Mac loans, we look in the rear view mirror. How did this asset perform over 1 month, 3 months, 6 months, and 12 months? That's called a T12. We're going to want to see that T12. We'll also want to see the rent roll. And we'll also want to see how you are analyzing it. How is your pro forma? And what are you putting in as assumptions? Remember, in multifamily finances, this is about the performance of the asset. It's not about how this property sold or is competitive to a property that sold down the street per se. The next course of action on a Fannie or Freddie is that we have LTVs, loan to values. Similar in that we see this in single family finance, but on multifamily, a lot of times the max LTV is going to be 80%, 30-year amortization. However, it's like a balloon payment, actually. So unlike single family, where it is amortized over 30 years, your principal and interest, it's amortized for 30 years. This is only for 5 years or 7 or 10 years, amortized over 30. However, the payments are much lower. We want to see on these types of debt experienced investors. Well, what does that mean? I have single family. We're really looking for someone with multifamily experience. So that might require a deal sponsor, someone who has experience in that area doing multifamily. That's who you need to find to put on your team. Also, lenders like to see that you have skin in the game. We're going to be using other people's money, but we want to see that you're bringing about 10% of the down payment for coming from your management team. We want to see who's flying that plane, who has their hand on that wheel. And it's really important for us to understand that you need to bring capital to these deals. The GP may be bringing 10% of that 25% down. And so let's take, for instance, a deal that is $15 million. Your down payment would probably be around 3.75. 3.75 is your down payment. We're going to require from the GP 10% of that. That's $375,000. Where are you going to get that? Well, you're going to find the rest of it coming from your investors, but we're going to want to see 10% coming from you or your deal sponsor or some of your investors that want to sign on the loan. Another requirement, as I mentioned, is net worth and liquidity. And how this works is we're going to require the net worth in the amount a little bit over the loan amount. Who has that kind of capital? When you're putting these deals together and putting your management team together, you're going to want to look for people that have the highest net worth and the highest liquidity to help you. Each person you bolt on to your GP, you're going to be paying or giving up some of your money to have them on your deal. So make sure you keep that in mind. If you put 15 people on a deal, that's going to cost you some money. So less is better in this case. We're also going to look for liquidity, being 9 months principal and interest or 10% of the loan. That will be required to be in cash, something that you can access. We'll be looking for your bank statements on that. We also see interest only on these types of loans. Unlike single family, we can get up to 3, 4, 5 years, depending on the leverage of the deal, in interest only. But for the most part, we're seeing 1 to 3 right now. Another area that you'll need to make a decision on is if you'll need yield maintenance or step down prepayment. This will be the way that we'll be structuring the deal, and the quote will follow. Yield maintenance is the cheapest option, but step down prepayment finance gives you a little bit more flexibility. Also, on these loans, Fannie Mae will provide an option for assumability of the loan. That may be a great option for your next buyer, and you do need to consider this depending on your strategy. They also make available to you a supplemental loan similar to a cash out refi, and we'll go into that in more detail in another module. But when it comes to agency, I want you to understand that this is a little different when it comes to signing on the loan. Not utilizing your balance sheet as collateral, it's actually utilizing your experience, and it's also utilizing the performance of the assets. The second option is the chocolate option, and this is CMBS, our commercial mortgage-backed securities. This is also a non-recourse loan, but these are looking for loan amounts of $5 million up to $100 million, or even further than that. So on CMBS, you really want this property to be stabilized, okay, and have limited rehab. And this is a cash-on-cash driven product. A lot of syndicators out there are looking at, well, what is their average cash-on-cash return over the 5-year horizon? And they may need 3 to 5 years of interest only. And CMBS will allow you to do that. And there are 75% of your purchase price on CMBS as opposed to 80% on Fannie. But you know what? The rates are very competitive. And if you actually go to a lower leverage deal like 50 or 60, you can get 10 years of interest only, which is a great deal. However, it doesn't really provide the cash on cash return like we would expect in a multifamily agency loan. There is a 2-year lockout on this product, so you'll need to be aware of the constraints and how that would affect your business plan. CMBS also has a prepayment penalty similar to yield maintenance. It's called defeasance, and it's still going to cost you to get out of the deal regardless if it's agency or CMBS. The biggest thing is CMBS loans cost a lot of money. Like $50,000 is your initial deposit. Also, these have a supplemental, but they're a little difficult and hard to put onto the CMBS. So it's difficult to re-lever the loan like you would in a supplemental where we can take money out and pay off your investors. We have seen CMBS work very well in secondary markets when Fannie can only give you 1 year of IO and 65, 70 on LTV. People are electing to go to 75%, let's say, in a CMBS product. So this is your chocolate option, CMBS. So let's go ahead and move on to our coffee ice cream. This is the non-recourse bridge. There are products out there that are recourse bridge, but this option is non-recourse bridge. This is high energy caffeinated coffee. We have seen an influx of this product over the last couple years, and this great option offering really starts at 5 million and above. It doesn't make sense for lenders to go lower than that, and it really is a product that goes with the option of a takeout after you do your rehab, your construction, to take it out to a Fannie as a perm loan. So where we see the rates on this being low is from lenders that want to take that perm loan. You do need to be experienced in this product. You need to know how to execute the business plan. You also need to know how to renovate the units in doing this, and your plan needs to be really 24 to 36. What we see on a bridge financing is it's a 3-year interest only, and you'll have 2 options of 1-year extensions. Now the rates will rise about 5 bips each one of the years on the extensions, but it gives you some flexibility. If your initial 3 years doesn't work, or rather not work, but you need to extend it, that extension is super helpful. Now remember, these are a risky option because we don't know what the takeout will look like. We don't know what the interest rates will be. We don't know where rents will be in 3 years. And like we talked about earlier, agency debt, we look backwards. And when we talk about bridge lending, we're looking forward. We're looking at the pro forma. We're looking at other properties that are being run, operated currently at higher rental monthly rents. And why is that? Why are they operating at the higher rents? What have they done? And we need to provide this to our lenders so that we can show them a succinct story of what is being done and how we're going to get there. So be prepared when you're looking at this option to tell us the entire story. Have a property manager give you the story of how they would run or manage this property. Also with bridge loan lending or this coffee ice cream, Fannie Mae may only give you leverage at 50 to 75% LTV, and your occupancy actually may be below 90%. So this is a great tool for you to use to raise those rents, do the rehab, and be able to get in at interest only. I mean, it's a phenomenal product. We can also get you up to 80% LTC. And by that I mean, you can put 100% of the financing of the rehab into the deal. Much bigger than what you'll find on Fannie and Freddie. The debt service on a product like this is 1.25, and these types of products, they close very quickly. When we've seen 60 to 90 days on agency, you're going to look at 30 days. So these things go quickly. Again, they've got 3 years of interest only. With that extension, the pricing is probably about 100 bips higher than what we see on regular agency debt. And it just depends on the location. You know, it varies from location to location. In the larger populations, we'll see that the pricing will be lower. They're not interested in doing any loans at that have 25,000 population. So the fees on these are 1% in and 1 to 2 to get out. So they're a little bit more expensive. And we work really hard on the takeout of these because that's where the money is for these lenders. And it helps to, once you have the idea that you're doing a takeout, if you're with the same lender, they will get rid of that 2% exit fee if they can take that perm loan. Our fourth choice in these lending options, or our ice cream flavor, is cookies and cream. This is a mix of vanilla and chocolate all mixed together. Lots and lots of private lenders are out there right now. They're trying to, be competitive with what Fannie Mae is doing, and taking some of the concepts and offerings of a CMBS, and they want to give you a product right in the middle. So private lenders options will give you 75 leverage, and they'll also give you like 4 to 5 interest only, and they may give you the ability to bolt on that supplemental. And in some markets where Fannie Mae is not aggressive, like maybe East Texas, and maybe giving you a 65% leverage, you don't need that stress of a bridge loan with 3 years maturity. This is where these guys do really well with the private loans. And they are willing to go 10 years fixed and 5 years of interest only. But don't forget, all of these loans, they have defeasance or prepayment penalties, and they are typically higher than what we see from agency or CMBS or from our bridge lenders. And so then we'll go into our last option, and that's option 5, Rocky Road. A lot of types of different options, and this one we're calling Rocky Road because it can be a rocky road. It's the recourse bank loan. A lot of syndicators years ago, this was the only option they had, and Fannie and Freddie came to know and provide a product that they do today because the bank financing didn't understand syndication. And so now that we've got Fannie and Freddie, a lot of these syndicators are allergic to the nuts in Rocky Road. They don't necessarily like the recourse because, again, this is going to, or your balance sheet as collateral. It's kind of like the bank is putting their hand in your wallet and saying, thank you, I'll have that until we're done with this loan. It really holds you hostage. You look for deals on loans. A lot of people do it below 5 million. However, there are bank lenders that are out there that are doing large deals above 5 million. They are not as, they're definitely going to be looking at the occupancy and the rents of the property and the cash flow to get the deal done. Now, on a bank loan, they may say, we'll do it on smaller deals, and we'll provide you with a 75%, but it'll be a 5-year fixed, and the rate will be over 5. And there will be step down prepayment. But it just depends on your experience, your location, what you're trying to do, where these may be a great option for you. At Old Capital, we have lots and lots of ice cream flavors that I've just shared with you. It's not just vanilla. We have Freddie, yes, Fannie on the vanilla, but we have CMBS, we have bridge, we have private, and we have recourse loans. We are able to analyze your deal and sort out and try to figure out what flavor is best for your business plan. We'll lay out 3 or 4 options to fit your goals. So let us know early in the deal, before you send in the LOI, what you are looking for. What is your business plan? Because we don't want to hear from you when you have $250,000 earnest money down and the possibility of losing that because you didn't pick up the right loan, or 15 days before it closed with limited options. We want to hear from you early, and we want to make sure we are providing you execution certainty on your debt. If you have any questions, I would be happy to go over them. I will be providing more finance modules in the future. This is just to get you interested, giving you a touch, a flavor for what Old Capital does, as well as what finance options are for you in the multifamily asset class. Thank you for your time. I look forward to hearing from you. If you have any questions, please give me a call. And remember that time kills all deals.